Florida is hitting a breaking point the governor can no longer ignore. Insurance companies are abandoning entire neighborhoods. Premiums are exploding past $10,000 a year, and new state data now confirms something once unthinkable. Huge parts of Florida are becoming uninsurable. And when a home becomes uninsurable, it becomes unsellable. When that spreads across multiple counties at the same time, the housing market doesn't just weaken, it fractures piece by piece, family by family. Florida officials are now facing questions they don't have answers for. How do you protect a housing market when the insurance companies themselves refuse to participate? How do you stabilize communities when homeowners are losing coverage overnight? These are no longer hypothetical fears. They are happening right now. This crisis isn't just about rising rates. Insurers are refusing new customers, denying renewals in bulk, and pulling out of entire regions at once. And it's not limited to high-risk coastal areas. Not just Miami or Naples inland regions like Orlando, Tampa, Lakeland, Gainesville, Ocala, and Jacksonville are now seeing insurance jumps of 40% to 100% in a single renewal cycle. Families who paid $2,400 last year are suddenly receiving bills for $6,000, $9,000, even $12,000 with no warning and no replacement insurer willing to touch their home. These are not rare exceptions. These are becoming the new normal. For many homeowners, insurance has now become the single most expensive part of living in Florida, more expensive than their car payment, their utilities, and in some cases, even their mortgage. The financial equation is breaking. A family that comfortably afforded their home last year is drowning today. A budget that once worked is now collapsing under the weight of costs nobody accounted for. When insurance becomes bigger than housing, the market begins to unravel one household at a time. But the most dangerous shift isn't the cost, it's the outright rejection. Tens of thousands of homes no longer qualify for coverage at all. Older roofs are denied instantly. Certain zip codes are quietly blacklisted. Houses that have never filed a single claim are being rejected simply because the neighborhood is considered too risky. These aren't bureaucratic adjustments, they are financial death blows. Even state officials, including the governor, now admit the crisis is accelerating faster than anyone expected. And when an insurer walks away, the fallout happens fast. The moment a policy lapses, banks forcibly attach their own insurance coverage designed to protect the lender, not the homeowner. It often costs 2 or 3 times more and offers far less protection. Overnight, families see their mortgage explode by hundreds of dollars a month, without warning and without an option to say no. It's a financial ambush, and it pushes households into distress almost instantly. This is why delinquencies are quietly rising across the state. Homeowners in multiple counties are now falling 30, 60, and 90 days behind on payments, the same early warning pattern seen before the 2008 crash. But this time, the cause isn't reckless lending or subprime loans. The pressure is coming from outside the mortgage system entirely. It's the collapse of the insurance market, something banks cannot control and homeowners cannot live without. Behind the scenes, lenders are preparing for what they call a distress cycle, a slow buildup of defaults that could hit the market in waves. Families who never missed a payment in their lives are suddenly being forced into late fees, forced insurance, and escalating debt. They didn't make a bad financial decision. They simply can't survive a jump from $3,000 to $9,000 in insurance, a single bill that destroys an entire budget. And now the cracks are spreading into the real estate market. Homes that used to sell within 48 hours are now sitting for weeks or months. Buyers walk in excited, ready to make an offer until they see the insurance quote. Suddenly, the home is no longer affordable. The property didn't change, the insurance destroyed the deal. As buyers back away, sellers begin lowering prices. Inventory rises, demand weakens, and fear spreads quietly through neighborhoods that once felt invincible. Florida's insurance crisis is not slowing down, it's accelerating. And the most alarming truth is that 2025 is not the worst of it. Reinsurance costs, the insurance that insurance companies buy, are set to rise again in 2026. That means another round of increases no matter how bad things are today. At the same time, migration is slowing. The out-of-state buyers who once fueled Florida's boom are now hesitating the moment they hear about $10,000 insurance bills. And as demand fades, the foreclosure pipeline is filling. Homeowners pushed into high-cost bank insurance this year won't show up in foreclosure data until 2026, but the early delinquencies are already climbing. Florida is now facing multiple crises at the same time: soaring premiums, shrinking insurance options, weakening demand, and rising financial stress on households. The foundation of the housing market is cracking, and every data report shows the pressure increasing, not easing. If premiums jump again, If insurers keep leaving, if buyers keep pulling back, Florida could enter a housing downturn unlike anything it has seen in decades. One canceled policy can push a family toward foreclosure. One uninsurable neighborhood can drag down an entire community. And the next round of state data will reveal just how deep this crisis may go. Stay alert, stay informed, because what happens next in Florida won't just reshape the state, it may change the future of homeownership across the entire country.